Price drops. Then it lifts again. The lower edge keeps getting tested. That is where the long begins. May 13th, Asia session forms near the upper boundary of May 4th, U.S. session memory. It does not form in open space. It forms with about 50% compression. It forms while overlapping older memory. That matters. When a session forms while compressed into older structure, the market is not free. It is crowded. It is pulled by old decisions. It is pulled by old rejection. It is pulled by old support and resistance at the same time. So the first task is simple. Do not chase the first move. Do not assume direction. Wait for structure to show where pressure holds. May 13th, Asia first pushes up. It reaches toward the lower boundary of May 13th U.S. session box. Then it falls. It tests the midpoint of May 4th U.S. session box. Then it rises again. It reaches toward the midpoint of May 13th U.S. session box. Then it falls again. It returns toward the lower boundary of May 13th Asia session box. That sequence matters. Up, fail, down, hold. Up again, fail again. Back to the lower side. The market is telling you something. The top side is not free, but the lower side is still being defended. That is why the long does not begin from strength. It begins from the lower boundary. It begins where the session returns to the edge and still does not collapse. Long entry line. May 13th Asia session lower boundary. That is the line where the market shows whether it still wants to defend the session. If that lower boundary holds, the session remains alive. If that lower boundary breaks and cannot recover, the long idea weakens fast. Now look at the stop loss line. May 4th U.S. session minus 150% area. Some traders will want a tighter stop. Some traders will want to hide it close. Some traders will want reward first. But a conservative trader does not begin with reward. A conservative trader begins with survival. Why place the stop that deep? Because the long is not built from a single candle. It is built from overlapping session memory. It is built from compression. It is built from repeated reaction around the same zone. If the market drops below the lower boundary and keeps pressing deep enough to lose the May 4th U.S. session minus 150% area, then the whole support argument is damaged. The market is no longer rotating. The market is no longer defending. The market is escaping lower, so the stop belongs there. Not because it feels comfortable, because that is where the idea breaks. Aggressive traders can do something else. They can tighten the stop. They can reduce the stop distance. Then they usually increase risk size. Because the stop width is smaller, sometimes that works. Sometimes price never touches the tight stop. Sometimes the reward becomes larger. But many times the tight stop gets clipped before the trade makes the full move. The opportunity is correct. The position is gone. That is the cost of being too tight. So a conservative trader does the opposite. Use the deeper stop. Reduce size. Protect the position from normal noise. Give the trade room to work. That reduces the chance of losing the position before the market pays. Now the first target. Take profit line. May 13th U.S. session midpoint. Why there? Because the Asia long begins from the lower side. The first job is not to imagine a huge rally. The first job is to get price back into the middle of nearby active structure. That midpoint is the first place where price can hesitate. It is the first place where the market may say, enough for now. So the first target belongs there. Then price keeps going. Now trailing becomes possible. First trailing target. May 13th U.S. session upper boundary. Second trailing target. May 12th U.S. session upper boundary. Third trailing target. May 11th U.S. session upper boundary. Fourth trailing target. May 6th U.S. session lower boundary. Fifth trailing target. May 6th U.S. session midpoint. Risk-reward ratio, 3.97. That is not a small trail. That is a long sequence. So the rule becomes even more important. Do not trail because you want more. Trail because price earns more. Every new target must come after price creates distance. If price reaches the first target and stalls, that is already information. If price reaches the upper boundary and still holds distance, then continuation becomes possible. If price then reclaims the next overhead memory, the trail can continue. So the trail is not hope. The trail is not greed. It is a response to earned movement. Now another question. How wide should the trailing gap be? Use at least about 0.5 in risk-reward spacing. That matters. If the trailing intervals are too small, the trade gets managed by noise, not by structure. Normal reaction comes back. Normal wick touches the moved stop. The trade exits. The move continues without you. That is not clean trailing. That is self-inflicted damage. So the spacing has to breathe. When you move the take-profit line, the stop must also move. Always. A trailing target without a trailing stop is not management. It is imagination. But the new stop must not become too tight. If the move stop sits directly inside normal pullback space, the trade loses profit too early. And one more condition. If the adjusted stop, even after not being too tight, still cannot move beyond the entry line, then in many cases, the trade is not worth trailing further. Why? Because the market is not giving enough reward to justify the extra exposure. Sometimes taking the profit is cleaner than pretending to trail. Now think about partial profit. A conservative trader can protect earlier. At the first trail, take 60%. Leave 40%. If the structure still holds, let the rest work. An aggressive trader can invert that logic. Take 40%. Leave 60% for the continuation. If the move extends again, a second trail can be split more carefully. A conservative trader can go 50%, then 30%, then 20%. A balanced trader can go 25%, 50%, 25%. An aggressive trader can go 20%, 30%, 50%. But the percentages only matter after the structure pays. They do not rescue a weak entry. They do not fix a broken stop. They do not create distance. Price must do that first. Now step back and watch the whole sequence. May 13th Asia forms with compression near the upper side of old May 4th U.S. memory. Price first pushes up. Then it falls back. It tests the May 4th U.S. midpoint. It lifts again. It reaches the May 13th U.S. midpoint. Then it falls again. It returns toward the lower boundary of the Asia session box. The long begins there. Not at the top, not at the first green candle, at the lower boundary. That is where the session either survives or breaks. Entry: May 13th Asia lower boundary. Stop: May 4th U.S. minus 150%. First target: May 13th U.S. midpoint. Then trail to May 13th U.S. upper boundary, May 12th U.S. upper boundary, May 11th U.S. upper boundary, May 6th U.S. lower boundary, and finally, May 6th U.S. midpoint. Risk-reward ratio, 3.97. The logic is simple. The lower edge holds. The session recovers. The recovery earns more space. Then the trail follows. The long does not come from optimism. It comes from survival at the lower boundary. That is the structure. That is the execution. That is why the long works. Price reclaims higher memory. Then it fails from above. The reversal is where the short begins. May 14th U.S. session forms near the midpoint of May 13th U.S. session box. It forms with about 50% compression. It forms while overlapping prior memory again. That matters. Compression in the middle of active structure usually means one thing. The next expansion matters more than the opening shape. So again, do not chase early appearance. Wait for the market to reveal which side cannot hold. From that midpoint area, price rises. It reclaims the upper boundary of May 13th U.S. session box. It keeps rising. It reclaims the upper boundary of May 12th U.S. session box. It keeps rising again. It reclaims the upper boundary of May 11th U.S. session box. It keeps rising again. It reclaims the lower boundary of May 6th U.S. session box. Then it reaches the midpoint of May 6th U.S. session box. That entire climb is impressive. But impressive is not the same as tradable. The important question is different. Can the market stay there? Can it hold that higher memory? Can it build distance beyond the May 6th midpoint? Can it accept above that upper cluster? If not, the higher push becomes a failure point. Then the short appears. Now watch what happens next. Price fails to stay above. It drops. It loses the lower boundary of May 6th U.S. session box. It drops again. It loses the upper boundary of May 11th U.S. session box. It drops again. It loses the upper boundary of May 12th U.S. session box. It drops again. It comes back to test the upper boundary of May 13th U.S. session box. That sequence is your answer. Reclaim. Fail. Lose stacked memory one layer at a time. That is the short. Short entry line. May 6th U.S. session midpoint. Stop loss line. May 6th U.S. session upper boundary. Take profit line. May 1st U.S. session upper boundary. Why enter from the midpoint? Because that is where the recovery becomes vulnerable. The market climbed all the way into the midpoint of May 6th U.S. memory. That is a serious location. If price can hold above it, the recovery remains alive. If price cannot hold and starts to fall back, the higher move becomes a failed reclaim. That is where the short belongs. Not from the first red candle. Not from fear. From failed acceptance at the midpoint. Why stop at the May 6th U.S. upper boundary? Because if price takes back that upper side, the rejection loses force. The market is no longer simply failing. It is trying to rebuild the higher reclaim. The short idea weakens. So the stop sits there. Tight enough to respect the structure. Wide enough to give the rejection logic room. Now the first target. May 1st U.S. session upper boundary. Why there? Because once price loses the May 6th lower boundary and starts giving back stacked reclaims, the next meaningful downside location is where older U.S. session memory waits below. That becomes the first destination. That becomes the first place where price can react sharply. Then trailing becomes possible again. First trailing target, May 11th U.S. session upper boundary. Second trailing target, May 12th U.S. session upper boundary. Third trailing target, May 13th U.S. session upper boundary. Risk-reward ratio, 5.48. That is large. But again, the market must earn every stage. The trail only continues if price keeps losing reclaimed memory. If price hits the first target and instantly snaps back, the trail is already doing its job. If price breaks lower and stays lower, the trail can continue. Now bring back the risk question. Aggressive traders may tighten the stop. They may reduce the distance. They may size up. Sometimes that creates a stronger ratio. Sometimes price never comes back. But conservative traders know the cost. A stop that is too tight can remove you from the correct short before the unwind fully develops. That is a terrible feeling. The analysis is right. The execution is too narrow. The move happens without you. So the conservative approach remains the same. If the stop must be wider, reduce size. Do not fight the chart. Do not force the chart to fit your preferred stop width. Protect the position first. Then let the structure work. Now the trailing rules again, but keep them alive. A trail needs spacing. At least about 0.5 in risk-reward interval keeps the trade from reacting to every small bounce. When the target moves, the stop moves too, always. But the stop must follow structure. If the move stop sits so tightly that a routine pullback can hit it, the trailing becomes self-sabotage. And if the new stop still cannot get beyond entry without being too tight, sometimes it is better to finish the trade cleanly instead of pretending there is more protection than there really is. Now partial profit. A conservative trader may take more sooner. At the first trailing stage, take 60%, leave 40%. That makes sense when the move has already traveled through multiple reclaim levels. An aggressive trader may keep more open. Take 40%, leave 60%. At later trails, a conservative trader can use 50, 30, 20. A balanced trader can use 25, 50, 25. An aggressive trader can use 20, 30, 50. Again, the split does not create the edge. The failed reclaim creates the edge. The split only manages the paid trade. Now connect the entire session. May 14th U.S. forms near the midpoint of May 13th U.S. box. It compresses by about 50%. Then it climbs through May 13th upper, May 12th upper, May 11th upper, May 6th lower, and reaches May 6th midpoint. That is the temptation. That is where many traders see only strength. But strength without hold becomes failure. Then the market turns. It drops back below May 6th lower, May 11th upper, May 12th upper, and tests May 13th upper. That is not random selling. That is failed reclaim selling. That is structure reclaiming control from above. So the short is clean. Entry: May 6th U.S. midpoint. Stop: May 6th U.S. upper boundary. Target: May 1st U.S. upper boundary. Then trail to May 11th U.S. upper, May 12th U.S. upper, and May 13th U.S. upper. Risk-reward ratio 5.48. The move first looks like continuation. Then it becomes reversal. That is why you wait. That is why you do not chase the first direction. That is why entry, stop, and target must come from memory, not from emotion, not from a fast candle, not from a late reaction. The market climbs. It cannot stay. The higher push fails. The short pays. That is the structure. That is the execution. That is the trade.